Hi, this is Praveen Khaitan. I represent iPlan Education. And today we're going to understand stock options, Greeks. The top 5 Greeks are delta, gamma, vega, rho, and theta. Let's start with delta. What is delta? Delta is change in option price or the premium with respect to the change in stock price. So let's say the delta is 0.06 and the stock price changes by 1, so obviously the premium will change by 0.06. So this option calculator is provided by my stockbroker. Okay, for that first we have to put the value of underlying asset. I'll take Nifty index option, which is an European option. Okay, and then we will find out the various Greeks. So calculate. We have to get the real price of the live price of the Nifty index. So for that I'll go to National Stock Exchange website, and we can see here we have the current price of Nifty, which is 8,324. So I'll put here 8,324 as the underlying asset value. Then we choose 8,300 as the strike price. Okay, and days to expiry, we have to check out how much time is left for the contract to get expired. For that we again go to National Stock Exchange website. I see the expiry date is 27th of November. That means it is around 24 days left. An annual interest rate, I understand that is 9% currently, which is normally the risk-free rate offered by government, the risk-free rate on the government bonds or the treasury bills. Now the volatility, again we have to find out from the option chain, which is available on the National Stock Exchange website. So I go here and look for the same strike price for the volatility. Now the strike price is 8,300 and the volatility is around 10.41. I can see here the volatility, implied volatility column will give me the volatility of the strike price 8,300, which is around 10.41. So I put the volatility here as 10.41. Dividend yield normally for an index option is 0. And now I'll see the actual value. Now the value for the call option is 128.2. Now this is the theoretical value as per the Black-Scholes formula. Okay, now let's see the market value. Now the 8,300 strike price is currently trading as 133. Okay, so the theoretical value is little lower and the market value is little high. Now this normally happens due to demand and supply. It's quite possible tomorrow when the market gets opened, okay, the price difference will be gone. Now, so this is how you calculate, use the option calculator. Delta is the change in option premium with respect to the change in price. So here the delta is 0.63. If I change here 24 I guess to 25, as per the delta it is 0.63, the option premium will increase just 0.63. Now so I change it from 24 to 25. Now calculate. Now we can see it's increased to 23 points. So from 21 paisa to it increased to 84. So the delta says that if there is $1 change, okay, in the underlying asset, the premium will increase to just 0.63. Now what is theta? Now theta says that change in option price with respect to time. So it says that option price will reduce, or the premium will reduce 2.9569 if 1 day passes. So let's say I reduce 20 days left to expiry, days till expiry from 24 to 23. Let's see how much the option price reduces. Exactly, it reduced around 2.98 something, and this theta also changed. What happens is all these figures are dynamic. So theta is basically the change in option premium with respect to the time decay. This is represented by theta. Now, what is gamma? Now, gamma is change in delta with respect to change in stock price. If the stock price will increase, the delta, the premium will change as per the delta. However, the gamma says if stock price increases, how much delta will change. So it says that it's 0.17 will be the change in delta if there is a change of just $1 or rupee 1 in the price. So let's say the currently delta is 6316, and if we increase 1 rupee in the stock price or the underlying asset price, there is an increase of 1 rupee, the delta should increase by 0.0017. So let's check out. So this should go to 636333. Now I'll increase this to 26 and just see. Exactly, the delta went to 6333. Okay, so it changed as per the gamma. Now let's check out what is Vega. Vega represents basically the volatility. Vega is change in option price or the premium with respect to change in volatility. So as it says that if employed volatility changes by 1%, how much will be the change in option premium? Now this is highly sensitive. We can see here this is 7 rupee, or in terms of dollars, $7. Let's see if you consider dollar. Then $7 will be the change in option value if just 1% changes there in the volatility. Now it's from 10, I increase 1 and just see the 7.86 change will be around 133 or 134. So just check it out. Now it's increased to 134.40. So we simply added the Vega if there's 1% change in volatility. Just imagine sometimes the market volatility is near 30. Was the value of option? Look at this, almost doubled. So volatility has an amazing impact or the great impact on option value. Normally it is said that when the volatility is very high in the market, you should short an option contract rather than buying that option contract. Now what is Rahu? Rahu represents the rate of interest. So if 1% interest changes, okay, what will be the change on option premium? So Rahu represents the interest, change in interest will impact how much the option premium. So let's say if we increase 1% interest here, so this will change around 3.24 into the option pricing. From 9 to 10 I calculate it again, so almost 3 rupees increased in the option value. Let's say if I reduce it 1% from 10 to 9, there has to be a reduction of 3.28, and it actually reduced 3.28 in the option value. So this is how we use an option calculator. Now let's understand the property of delta option Greeks. Here let's understand the properties of the delta by using an option calculator. The inputs here we are taking is 200 is the price of underlying asset, 9% is the annual volatility, strike price is 200, annual volatility is 40, time to expiration is 30 days, the contract is for 1 month, and by using all these variables inputs we get the option price is 9.87, and we have already understood if I increase the price by $1, the call option price will increase by with respect to the delta. So delta is 0.548. If I increase it just 1, then we'll see it's almost increased as per the delta. Now let's go back. Now I want to understand what happens exactly if the option, the contract which I bought for a strike price of $200, Now what happens to that if it becomes more in the money? So how it becomes on the money? If the underlying asset increases, the value of the underlying asset increases from 200 to 110, 20 or 30 and 40. What happens if this happens? For that, what I have done is I'll increase the value of the underlying asset. So I increased it 10, 20, 30, 240, 50 and 60. Now I just have plotted that on a chart. Now what happens is as this goes, underlying asset increases, the option goes more in the money. When option goes more in the money, the delta increases. We can see there's an increase of delta, and out of the when the price reduces, this option becomes out of the money, and this situation the delta reduces. So the same thing is plotted here. More in the money option, the more is the delta. The less is in the money option, the lesser is the delta. Now what happens with the time? Change in delta with respect to change in expiry. What happens, let's say, understand, if we keep all the factors same, all the other factors same, and if we increase the expiry of the underlying asset, then what happens to the delta? Now let's say I increase the expiry value. Now I can see here the inputs were 90, now it is 100, 110, 120 and 30. As the time expiry is increased, so that means the contract is for, instead of a month, it becomes a contract for around 3 months, okay, or 5 months. The contract expiry is delayed. The delta is in increasing order. So we can say the longer the contract expiry is, the higher the delta for that contract. And the shorter the contract expiry is, the lower the delta for that contract. So understanding gamma with respect to change in underlying. Now let's understand all the variables remains the same, and what we do is we simply change the prices, and we'll see how the gamma reacts to the change in price. So I'm changing the underlying price. Now what I have seen here is the strike price is 200, and as the price increases, this option contract becomes more in the money. So if it is more in the money, the gamma is very low, and it becomes too much in the money. Or same, if we say it's become too much out of the money, it also becomes low. And the gamma is at the highest when the price is, the underlying price is at the money or near to the at the money. Let's understand change in gamma with respect to change in time. So all other variables remains the same. What I do is I change the time. Now let's understand change in gamma with respect to change in time. Now all the other variables remains the same. What I'll do is I'll change the time. Now I see here the inputs, the time is increasing for different contracts. So what happens is as the time increases, the option contract has a longer expiry. So there are various kinds of option contracts. If you understand, there's 1 month, 2 months, 3 months, 5 months, 6 months. So there are 2 years option contracts also. So the longer the option contract, okay, we have a lower gamma. The shorter the option contract, we have a higher gamma. So we can say as the option contract reaches its expiry, okay, there's less time left in expiry, the gamma is very high. So the options delta changes very fast. Understand change in Vega with respect to change in underlying asset. So what I do is I increase the value of underlying asset, and we'll see what happens. Now we can see the underlying assets are increasing and our option contracts are becoming more in the money. So here on the plot we can see when it's at the money, the Vega is very high, the volatility is very high, and as the price increases, okay, or the option becomes more in the money, okay, the volatility reduces, okay, or again, if we see if the option or the contract becomes more out of the money because price reduces, if price reduces too much, the options Vega is also reducing. Okay, so as the price reduces and options become more out of the money, the Vega reduces, and if the option price, so we can see the more in the money option has a lower Vega, or more out of the money option has a lower Vega. But Vega is at the highest when the option is at the money. With respect to change in time, what happens if time changes, variables remaining the same? What we do is we change in the time to expiry variable. So what I do is I reduce or increase it by 10. So what is happening here is the time is increasing, so options is becoming more expensive, longer expiry. So what happens is we can see here, if the option has longer expiry, the Vega is high, or if the options has a lesser, let's say short expiry, the Vega is normally. Let's understand the theta with respect to the change in underlying asset. Now all the variables remaining the same, I just change the underlying value. Now I'm changing the underlying value to see the value of theta. Now what is happening here is, if the option contracts becomes more in the money, so that means the price increases. Okay, now in that situation I can see the theta is reducing. Okay, and the time decay, that means if it is too much in the money, as every day passes, there will be less reduction in the value. The value will reduce less, okay, as the time passes. And if it is out of the money, the value will even reduce less, okay, as the time passes. So an out of the money contract, okay, value will reduce less if time passes, okay, with the time decay. And highest value reduction will be, okay, and when the option is at the money. So we can say here, at the money or near at the money option contract, okay, has the highest theta. Now let's understand change in theta with respect to change in time or the expiry. Let's say all the factors remaining same again, time to expiry increases or reduces. So I see here, if there is a longer period, okay, if the contract as, let's say, has a longer expiry period, the theta is low. Whereas if the contract expiring is very near, the contract expiry is near, the theta will be relatively higher. So there will be more loss of value. So theta is again highly sensitive to the time decay. So as we can see with the chart, that if the option contract has a longer duration, the theta is normally low, and if the contract gonna expire in near future, it's very soon, the theta is higher. Change in rho with respect to change in underlying value. So what happens if the underlying value changes? Okay, what happens with the underlying value? What all the other factors remaining the same, I change the underlying value. Now, so it's the option contract which I bought for $200 as now more in the money if price goes to $260, or let's say as the price increases. We can see here with the chart, as the price increases, the value of rho, okay, increases, and as the option goes out of the money, the value of rho reduces, so it becomes near to 0. So the rho is basically the rate of interest. Okay, with the change in rate of interest, we see there is a change in premium, but also how much premium will change. Okay, that depends on the price on the option also. If the option is higher in the money, the change will be high in the premium, and if the option is more out of the money, the change in the option premium will be less with respect to the change in rho. So if the rate of interest changes 1% and the option is far out of the money, there will be almost no significant change in the premium. Whereas if the option is in the money, too much in the money, and there's a 1% change in rho, there will be high impact over the premium. Okay. Now let's understand the change in rho with respect to the change in time. All the other factors remaining the same, I change the time. Now I can see here the longer the expiry, okay, the higher the change in rho, and the near the expiry there is less change in the rho. That's enough for the option Greeks. If you have any doubt, you can visit our website, that is iplaneducation.com. Have a nice day. See you in the next video.